Hello students, I hope you're all doing well. Welcome to another video from QuickStudy. This video covers sources of business finance from topic 1.3, putting a business idea into practice. So without any further ado, let's get started. In this video, we'll learn about sources of business finance for a startup or an established small business, which includes short-term sources of finance like overdrafts or trade credit, and long-term business sources of finance as well, such as bank loans or venture capital or personal capital. So students, you need to understand that raising finance can be complicated, and there are three important questions that you need to ask yourself. First of all, you need to know how secure is the source. So capital that a business raises by selling their shares remains with the business, which makes it 100% safe way to raise capital. And whereas bank overdrafts are not as safe because they can be cancelled at any time by the bank, which means that the bank can demand for their money back within 24 hours, which can put you in a tight spot. And the second thing, or the second question that you need to ask is, how expensive is the source? Now, raising capital is expensive, and it can be particularly difficult when you are starting a business. And investors want high returns for the risk that they're taking. Since there's a risk of losing all their money, they want as much return as possible, right? Which makes business financing expensive. Then thirdly, you need to ask yourself if you are raising enough money. Since capital is hard to raise and manage, businesses want to borrow enough money using which they can get away with, right? And it is quite difficult to anticipate all the problems that a business might face when they're starting out, right? But it's way safer if you are to raise at least, or if a business were to raise at least 25% more money than they actually need, which can work as a safety net. And now we are going to have a look at short-term and long-term financing. So when you are trying to raise finance, you need to consider the timing of cash requirement, or per se for how long you're going to need the money. So when it comes to short-term financing, it means that you actually need the money for probably a few weeks. And bank overdraft seems an appropriate way to raise a short amount of money for a short period of time. Even though they are relatively easy to manage or facilitate, they can be expensive. And then comes long-term financing. This is the kind of financing approach that you could use that when you need the money for several years. An example could be a 10-year lease on a shop that requires at least 10 years of financing. And in case of long-term financing, you can't really use bank overdraft since first of all, it's expensive and it's inappropriate. So first of all, we are going to have a look at how long-term financing can be put to use. So long-term financing can provide you with the startup capital that can finance the business for its whole lifespan. Then you could also use the money to purchase assets like property and buildings that can provide you with benefits for a long period of time. Moreover, long-term financing can also help you with the capital to expand or grow bigger. You might want to build a new factory, or you could also plan to buy another business. And students, now we are going to have a look at how short-term financing can be useful for you. First of all, there might be periods when cash flow is poor. For a seasonal business, say for example, if it's a hotel and it's a seaside hotel and during the winter season, there is not a lot of people coming in and you need some extra money, right? And then there are periods when your customers will delay their payments. Probably it's a big customer and it's a large chunk of money. And since they are delaying their payments, you might not have enough cash to pay for your bills. Then another instance could be when you are operating at full capacity and there is a sudden order and it's quite a large order, so you are not really prepared to produce at that capacity, which means you would need additional money to buy more raw materials, hire more people, since your laborers may have to work overtime. So in this scenario, you would need extra money. And these are the cases when short-term financing can be really helpful for you. And now students, we are going to take a look at the different sources of long-term financing. The first one being personal savings. So most new businesses are usually started by people who have some savings of their own, and they're using that money to start their own business. You see, venture capital firms or shareholders would only want to invest in a business where the owner themselves have taken some risk and started the business, right? And similarly, banks will favor businesses where the owners have shown proper planning and a long-term commitment with regular savings. I mean, no one wants to risk their money on someone else's whim, right? And the second source of long-term financing is share capital. Share capital is basically part ownership of a firm. If I were to give you an example, say you have purchased 10 shares in a company which has 100 shares in total. It means that you have 10% of that company's ownership. And it also entitles you to attend the annual general meetings and also vote for the board of directors. And at the same time, it also entitles you to dividends that will be paid out from the firm's profits every year. And students, it's also important that you consider the benefits that come along with share capital. So first of all, the business has the capital permanently. I mean, the shareholder of the company can only cash in from their shares by selling their shares to someone else. They do not really get the money back from the company, right? And also the second benefit that share capital will offer is that dividends does not really have to be paid every year. I mean, it's not really a must. In a bad year, when a firm is suffering from losses, they do not have to pay out dividends to their shareholders, which is very much unlike interest payments in terms of bank loans, which must be paid regardless of how the business is performing. And since we have already talked about some of the benefits that share capital has to offer, it's important that we also look at the drawbacks that come along with it. So first of all, it's important for you to understand that issuing or selling too much shares means that you are diluting the ownership of your business. And it's critical that you have at least 50% or more of the shares or ownership in a company to retain control or influence the decision-making process, right? And also the second drawback that you need to consider in terms of share capital is that a business that is listed on the stock exchange is vulnerable to a takeover bid. And in this scenario, and if I were to give you an example, this is exactly how Nokia was taken over by Microsoft, by the way. It was termed as a hostile takeover, where Nokia wasn't really willing to sell off their business to Microsoft, but they were in so much need of capital that they had their business listed on the stock exchange and Microsoft just acquired them. And this goes on to show how it puts a business in a vulnerable position. And basically, this will influence your decision making. And in these cases, a business will often prioritize higher profits so that their share price in the stock market is kept at high, which makes it difficult for competitors to buy them. Now, another form of long-term finance is a loan, and this is usually obtained from a bank. And it can be in the form of a mortgage, which can go for as long as up to 20 years, or it could be in the form of a bank loan, which could be anywhere from 5 to 8 years. And it's important that you understand there are certain key characteristics of a loan. The first one being that interest payments must be made on time. Failure to make the payments for your interests on time could lead to your business being closed down, or it might also lead to you being taken to court. And then you also need to understand that almost all loans are secured against an asset, which essentially means that if your business were to take out a loan from a bank, they'd have to put an asset to the bank as a form of security or a mortgage, which could be the firm's assets such as the premises, or it could be vehicles, or it could be land and buildings. And if you are not able to make payments to your bank for the loan that you've taken out, you are at risk of losing the asset that you have put up against your loan, right? And then another factor that you need to consider when it comes to loans is that the interest rate may be fixed or it might be variable. And it actually differs from firm to firm that how they prefer their interest rates to be like. And another form of long-term finance is venture capital. So a venture capital firm or a venture capitalist is willing to take risks to share in the rewards. So basically, venture capital is usually in the form of both share capital and also a loan. What they essentially want to do is invest in your business in exchange for part ownership in your company, right? And they might also give you extra money in the form of a loan. And venture capital firms or venture capitalists will often invest in new to small or medium-sized businesses as opposed to large businesses. And another source of long-term finance is basically retained profit. And research has shown that over 60% of all the money to expand a business usually comes from the profits that the business has made. And this is an ideal source of capital for a business since there are no costs associated with using retained profit as a form of business capital, since there are no interest payments that you have to make, or you wouldn't also have to pay dividends to your shareholders, right? And well-run businesses will often aim to fund as much of the business's capital requirements from the profits that they have made. And another source of long-term financing is crowdfunding, which is basically getting investment from a wide range of small investors, each paying for their shares online. And this is ideal for businesses for which the idea seems to be too risky, but where a bank wouldn't invest in, but it seems attractive for ordinary people and possibly who are actually investing for the first time. And there are several advantages that comes along with crowdfunding. The first one being that it acts as a mixture of financing and market research. You see, if investors aren't really attracted to invest in a business, it might indicate that the business idea isn't really going to work out or it's not really distinctive enough. And then it also provides you with an advantage that if you fail to finance for a business using crowdfunding, it might be a blessing in disguise, which is telling you that the idea is not really strong enough for the market that you're operating in. And at the same time, crowdfunding can turn out to be an amazing opportunity for a person who doesn't really have enough money, but it is essentially their dream to have a startup or this business. And then you'd also have to look at the disadvantages that come along with crowdfunding, which includes that when people invest in businesses using crowdfunding, they are only going to invest if they like the idea of the business. And it's not really effective for businesses where the idea is not really that interesting, right? And startups, which have been known to use the most famous crowdfunding website out there, like Kickstarter, has shown statistics to be around 33%. I mean, a business is successful in raising money using crowdfunding from a popular website like Kickstarter, like only 33% of the time, which means the rest of the time they are failing. And the success rate for new small companies on other crowdfunding platforms can be as low as 3%. And now, students, we are going to take a look at the sources of short-term finance. And we can start the sources of short-term finance with bank overdraft, since it's the most popular one that businesses will use. And an example I could give you with bank overdraft is that a bank will allow an account to go up to a certain limit, say for example £5,000, which means that a business can go in the red or to a negative balance of up to £5,000, and this amount will vary according to different days or even by the hour. And you need to understand that there are certain characteristics or features of a bank overdraft. First of all, the interest rate or the interest charge for a bank overdraft is variable, which means it doesn't really stay fixed. The cost of borrowing will change if the UK interest rates changes, which basically adds a level of uncertainty for small businesses. And unlike a £5,000 bank loan, which requires monthly payments based on the whole sum, an overdraft facility is used as needed, right? And there is a potential risk that arises with using bank overdrafts. I mean, the bank can demand for full repayment of the entire overdraft amount within 24 hours, which can put you in a tight spot. And many firms that collapse financially are finished off actually by banks using this demand, that they will suddenly ask for the money that they have lent out to you. And now, students, we are going to talk about a different form of source of short-term finance, which is basically trade credit. And it's very important for new and small businesses, actually businesses of all kinds, to maintain a good relationship with their suppliers. I mean, if you are buying materials from your supplier on a regular basis, they will provide you with cash discounts and better payment terms and whatnot. So small firms will rely heavily on good relationships with their suppliers, right? And at the same time, big companies can actually use this as a bargaining power. Since they are a bigger company who are dealing with their suppliers, these big companies are ordering for materials on a larger scale. So they have a bargaining power that they can use with their supplier, which can actually even drive down the prices of the products, right? And then there are several benefits that come along with having a strong relationship or a good relationship with your suppliers. So as I have already mentioned, that you can avail better credit terms from your suppliers. They can also give you discounts. And this can be an amazing way for a small business or a new business to maintain a good cash flow if your creditor extends the payment terms or provides you with good payment terms. But there are also problems that come along with new or small businesses when it comes to trade credit. So first of all, when you're a new business, your supplier doesn't really want to give you trade credit because they don't really know you that well. You don't really have a rapport. You didn't do business with them in advance. And suppliers may even ask for money in advance as a form of safety or security. And since there is no place of trust, right? And suppliers aren't really willing to do business with a new firm, as opposed to, since they usually have an established customer base, so they do not want to take additional risks. Now, when you are deciding on raising share capital, first of all, you need to determine how much money you need and for how long you need it. And there are three broad categories from whatever we have discussed so far. There is loan, there is share capital, then there is retained profits, which is basically the money from your profits which you will reinvest onto your business, right? And the expert advice is to balance out between the three as your capital sources. And it's wisest not to rely too much on either share capital or loans. And students, with that, we have come towards the end of this video. And to give you a short recap, this is what we have covered in this video so far. We have talked about the sources of finance for a startup or established small business. We have talked about short-term financing, the different forms, which includes overdraft and trade credit. We've also discussed long-term financing, which includes personal savings, venture capital, share capital, loans, retained profit, and crowdfunding. And students, if you've liked this video, I would ask you to subscribe to our channel, since we post videos on different topics and subjects that can help you ace your GCSEs. And for more information on our one-on-one tutoring services, do visit our website at www.quickstudy.uk. Thank you.